Hey, I'm Gene Goldman. Here's a look at the week ahead for the week of November 6th. Last week, U.S. equities were very strong. For example, the S&P 500 has best weekly performance since November of last year. The drivers behind last week's rally: lower bond yields, the Fed seemingly done raising rates, and corporate earnings exceeding expectations. All of this comes in the heels of the S&P 500 falling into correction territory the week before. As a reminder, a correction is a peak to trough decline in an index by 10% or more. And as you see here on this chart, they are a normal part of investing. On average, corrections occur about once per year. And by the way, our last correction in the S&P 500 was a year ago, September of last year. So the question we got to focus on for this week is, given all this market volatility, what are some key data points to watch for potential clues on market direction? So determining potential market direction can entail looking at thousands of factors out there. Of course, you need to watch the direction of the economy and corporate earnings, but this week should be a very quiet week for economic data. And with 81% of the S&P 500 already reporting earnings season is nearly over. So with little economic data this week, let's focus on some key market and sentiment factors to gauge how healthy last week's rally was and possibly can it continue. So first thing, let's start with market breadth. In a rallying market, you want more stocks moving higher in the rally. So for example, throughout the year, there's been this big discussion about the so-called Magnificent Seven stocks, that 7 stocks have been primarily driving the market's return. Not a great data point. But as you see here, one key way to measure market breadth is the percentage of stocks trading above their 50-day moving average. Last week, good sign. As this red arrow shows, market breadth was definitely improving. It was moving higher. Another data point to look at is the spread between bullish and bearish investor sentiment. It's a contrarian indicator. So in other words, if more investors are bearish, it's a bullish sign. You see here in this red circle, sentiment is decidedly bearish, a good sign for the market rally to continue. The third factor, valuations. Let's look at the PE ratio of the S&P 500. Despite having the best weekly performance of the S&P 500 this year, valuations are not that high. So before the correction, the PE ratio of the S&P 500 was about 19.5 times forward earnings. Today, it's 17.9, as you see here. So the big takeaway this week is that after the big, strong week we had last week, the questions are abound. What's next for the market? But we get very little information this week on the economy or corporate earnings. But there are some key market and sentiment factors that we can focus on. We highlighted 3 today: market breadth, bull-bear sentiment, and valuations, and all 3 paint a positive picture for the market. Thank you for listening. For more information, please follow us on Twitter at Cetera IM, and see you next week, and thank you.